Hello, everyone, and welcome back to today's daily analysis. Today's the 16th April 2024. First, for the US dollar index, which is currently trading higher near 106.24, benefiting from a strong economic data and rising US Treasury yields. The index's recent rise coincides with the cautious market sentiment due to tensions between Israel and Iran, which is supportive of the dollar. Fed Reserve Chairman Jerome Powell's comment suggests that an easing cycle may begin later in the year, possibly in the fourth quarter, which could lead to a change in investor expectations for a rate cut. The dollar's positive performance also aligns with gains across maturities and suggests one or two rate cuts may happen for the remainder of the year. From the technical perspective, the US dollar index appears to have a room for further short-term gains. The 14-day RSI shows upward momentum and suggests that bullish traders are influencing the currency's price action. The resistance levels to watch include 106.51, 107, 107.11, and 107.17, while initial support levels are around 105.38, 105, and 104.85. The dollar index remains above the 200-day moving average, reinforcing the general trend for further gains. Next, for the spot crude oil, the WTI oil briefly fell below $85 following Iran's drone attacks on Israel. But the attacks did not have major impact, and the oil prices remained range-bound. The US dollar index rose due to the optimism in the US retail sales, trading just under $85 per barrel. Traders await Israel's response to the Iranian attack before making new directional bets. The conflict have raised concerns of the wider regional conflict that could impact Middle East oil supplies, but muted market reaction suggests headwinds for crude oil prices. From a technical perspective, the WTI crude oil prices remained weak, with the complex fundamental backdrop keeping traders on the sidelines. Key resistance levels to watch are around $87.10 to $87.15. And 88.37, with potential strength acting as triggers for bullish traders. The upside may continue towards the $90 mark, while initial support lies around $84, 83.97, and further down to 82.23 and 81.6. Continued monitoring of the situation and these technical levels will be crucial for traders in assessing future market movements. And then the gold prices fell towards the 2,330 area during the European session before rebounding to 2,387.6 in US trading, largely due to the escalation of the conflict between Iran and Israel over the weekend. Investors rushed to the traditional safe havens, supporting gold prices due to fears that Iran's attack on Israel could lead to further conflict. Despite this, the rising US Treasury yields above 4.6% and increased demand for the US dollar as a safe haven investment pose headwinds for gold prices. From a technical perspective, the gold remains overbought with the relative strength index above 70 on the dollar daily chart. Despite this, the investors are paying a little attention to technical trends as the gold continues to trade in uncharted territory. If the gold prices hold above 2,400, it could head towards the psychological level of 2,500. On the downside, support levels to watch are 2,340.9 and 2,300, which could serve as key support levels for gold bulls. Next, for the AUD-USD pair, it extended its bearish trend for a second consecutive session, hitting a new yearly low near 0.644 due to continued strength in the US dollar. The pair recoupled some losses on Monday, trading around 0.648 during the Asian session, but struggled to make significant gains. Geopolitical tensions in the Middle East, particularly Iran's attack on Israel, did not have major impact on AUD-USD. The Australian dollar received some support from the positive tone in US equity futures, but the hawkish expectations from the Fed and geopolitical tensions capped the pair's upside. The technical analysis indicates bearish sentiment for the AUD-USD pair, with the MACD below its midline and showing divergence below the signal line. The key support levels are near 0.6455, which is last week's low, and 0.6442, a low hit in February. A drop below these levels could see the pair trade around the 0.64 psychological level and 0.6338, a low hit last November. On the upside, resistance lies near the psychological level of 0.65. A break above this could lead to a test of strong resistance in the 0.6545 to 0.6555 area, coinciding with the 200-day moving average and then the 100-day moving average near 0.6598. For the GBP USD, it experienced a decline towards 1.245 during the US session, erasing most of the day's earlier gains due to continued US dollar strength following better than expected data. Although the pair rebounded slightly during the London session on Monday, its near-term demand remains subdued amid deepening Middle Eastern tensions and speculation that the Bank of England may begin to cutting interest rates sooner than the Federal Reserve. The GBP/USD briefly fell to its lowest since November, reaching 1.2426, before recovering slightly to rise above 1.2490. The outlook remains bearish, but easing geopolitical tensions could support the pair's rally. Upcoming UK jobs and inflation reports this week could also impact it amid the repricing of global interest rate cuts expectations. The long-term trend for GBP/USD is bearish, having fallen below the psychological support at 1.25 and the 200-day exponential moving average. The daily chart displays a head and shoulder pattern that suggests a bearish reversal. Key support levels include the psychological level of 1.24 and 1.239, with further potential declines towards 1.2364 if these levels are broken. On the upside, initial resistance lies at 1.25, followed by 1.2581 200-day moving average, with further resistance at 1.2652, 50-day moving average. The 14-day relative strength below 40 signals new bearish momentum in the short term. For the USD Japan Yen, traded at the 34-year high above 154 on Monday, driven by uncertainty over future interest rate hikes from the Bank of Japan and the central bank dovish stance. This weighed on the yen and limited its recovery against the US dollar. Traders remain cautious of the making aggressive bets against the yen due to possible market interventions from Japanese authorities and geopolitical tensions in the Middle East. Despite these concerns, the US dollar is expected to consolidate its recent gains and maintain a strong position due to expectations of delayed interest rate cuts from the Federal Reserve. From a technical perspective, last week, breakout above the 152 mark has provided a bullish trigger for the pair. It appears poised to continue its uptrend towards 154.66 and 156.36. However, the overbought RSI on the daily chart suggests the need for near-term consolidation. Any significant corrective decline below 153 could attract fresh buyers and remain limited near 152.6, while a convincing breakdown might lead to technical selling towards 152, 151.4, and 151 round figures. The Euro USD fell further to fresh 2022 lows near 1.062 due to the continued strength of the US dollar amid differing monetary policy outlooks from the Fed and the European Central Bank. The pair edged to around 1.065 during Monday's Asian session, recovering slightly from a 5-month low of 1.0622 hit on Friday. The geopolitical tensions in the Middle East, particularly Iran's attack on Israel, added pressure to Euro USD. However, markets remained relatively calm, possibly due to the Iran's advance notification of the attack. The central bank's potential policy rate cuts, if underlying inflation slows further, have also contributed to the downward pressure on the euro. For technical indicators suggest recent oversold conditions for Euro USD, with the RSI on the 4-hour chart falling to 20. The resistance levels include 1.07 and 1.0712, with the potential for further stabilization above these levels. The next obstacle could be at 1.0765, and on the downside, support levels are at 1.06 and 1.0596, with the next support target towards 1.0516, last November one low. And that is all for today's daily analysis. Thank you for watching and have a nice day.